3, 2, 1. Perfect. Here we go. How you doing, friends? This is Ernie, and this is the 73rd episode of 0 Days to Expiration. And today, we are going to talk about volume profile. Volume profile is by far the best way. Now, I am making this sort of platitude, and this is how I feel. And I'm sure some of you will argue with this stance. Those technical analysis aficionados, you Elliotticians, you price action wonks. You say, what is this volume profile? I hear so much about it. Or, oh, that is just a bunch of crap. There's nothing to it. There's no proof that price goes by that volume stuff. It's because they're so fixated on price and price action. And they're invested in all of these indicators that they use that get stacked up at the bottom of their chart, almost to the point where it squeezes the chart into nothing. I remember when John Carter when he first came on the scene, and he was pushing this TA methodology using the Bollinger-Keltner squeeze. Now, some of you may or may not be familiar with it, but it was popularized by what he had. And then on top of this doubling of two volatility indicators and their interference, he would then add, 3, 4, 5, 6 different oscillators underneath it. And it was crazy to think, and through all of that, all of those oscillators, they're all pegged off of the exact same thing, including the Bollinger-Keltner squeeze was also pegged off of price. How is it that you can get any kind of real-world information when you're dealing with just one piece of information? One solitary piece of information, and then just slicing it and dicing it into many different things, as if that is somehow going to extract the underlying cause for price to move. And the underlying cause for which price moves is supply and demand. And that demand and supply can be seen in the flow of volume, the flow of where people are trading, what price levels people are trading, whether price is accelerating into that level or being pulled out. The old stock operators of old, like the Jesse Livermore type, and the people that had nothing but a stock ticker to go by, how do you think that they evaluated the market? They saw the ticker come across. They saw price, time, and volume. All three. And as the ticker came by and they saw the volume pick up, they could get a feel for where the market was finding value and where it was not finding value based on price levels and volume. Now, that activity has made its way and has been a stalwart through the millennia, the decades, into this computer age where we were able to start seeing live charts. And this is really a recent phenomenon when you think about it. Not until we started getting online services and even dial-up services. And a lot of you probably don't even know what the hell I'm talking about, using a modem with all those weird sounds. And until then, nobody was getting real-time price information if you didn't have a ticker or a Bloomberg terminal or some other type of direct access to the market. You had to wait for the newspaper to see what the prices were. And you could only look at historical information. You couldn't look at real information. And calling up your broker was an expensive proposition to make a trade. But today, everything is instantaneous. We get all this instantaneous information. We get charting. And still, people are fixated on just price when all the professionals have been using volume and price levels and order flow to make their decisions.
New visitor.
So along comes volume profile. Actually, first, prior to volume profile, there was a way to start codifying the ticker tape once the ticker tape went away into something that was called market profile and using time price opportunities, where they were also just using price, but they could simulate the volume and by stacking up the orders at different price slices so that they could get a histogram of where those orders were and at what frequency that they were happening, and it would build a sort of this horizontal histogram, kind of a normal distribution of prices at different levels. And that gave a pretty good approximation because it used basically tick data, which in a way approximates the volume at those particular levels about with 93, 94% accuracy. So they used this thing called market profile and developed all of these terms like value area high, value area low, point of control, TPOs, all of this stuff. And then as data became and the internet became more prevalent and exchange data became easier to manipulate, they found that they could use or create a volume profile that did a much better job than market delta or market profile could provide. And instead of using tick data, they could use actual volume so that they could see the actual number of trades that were traded at specific price levels and then start building this histogram, this distribution of intent. That's what it really is, the distribution of intent at various levels. So what one could say is that when you have one of these histograms that sit on the right side of your chart or the left side, you can actually see where the market spent the most time at specific price levels. And so you could make that assumption that, well, if a volume node or this grouping of volume at a particular level was very, very high and it looked like a node, then you could say that the market found value at that particular level. And if there was a dearth or a complete absence of volume, what some people call a value level low, I call it a volume well, you could say that the market, for whatever reason, finds no value there. Why? Nobody knows. But it happens. So price gets distributed at various levels that the market collectively has determined there are some levels that have value and some levels that don't have value. And this really corresponds very nicely, well, or it can be reflected very nicely in price action and your candlesticks and price bars, where you can see that price tends to move very quickly through these areas where there's no value and then consolidates on these areas where you see the big volume node or where there is value. And if you were to do an analysis of how much time the market actually spent in those times where there was no value versus where there is value, about 30% of the time the market is spending in those times where there's no value. In other words, it moves very quickly through there. And those are the times when there's impulsive action in the market. These big players are moving the market very quickly, trying to find or discover where the next level of value is. So that's a very specific behavior. Price is moving very quickly through these low volume wells or value area lows. And then when they find places where the market universally finds that there is value, they hang out there and then they start trading, building up volume, building up a node. And that node has a very specific shape. Now, one can say that the intent or the trades that actually occur at those nodes, they may be good for that day, in and out and gone, or they could be positions that people are holding over a long period of time. And I'd say proportional to the nodes, you could say that going back far enough, there are people that are still holding those positions. And we know that institutions tend to keep an inventory of positions. So we know that they have positions at these nodes, even if they're a month or 2 months old. And so those positions may be defended or used for whatever strategy people have. And when price revisits these positions, it exhibits a very specific type of behavior depending on whether or not there is a value node or a volume well. See, that's a well. That's a node. Right? See, here's 2 nodes. And then in between's the well. So you have this volume node and volume well, and price is coming across it. Price tends to gravitate towards the areas of value and tends to scoot through or move very quickly through the areas of no value. Now, there's another important point here. A lot of volume profile practitioners are fixated on the POC, the POC being the highest point on a volume node. They call that the point of control. And they would say that is an area of support and resistance, which is a completely wrong notion. I'm here to tell you right now that all you practitioners of volume profile that think that the POC represents support and resistance, you are completely wrong. It does, in fact, represent an area where price will gravitate towards. In fact, the price will tend to oscillate between that node. But it's the edges of the node that provide areas of support and resistance. Why? Well, that, just by definition, is where price is bumping up to the top of the edge of a node and then bouncing and then going down to the bottom and then going back and forth inside of that node. So they are, by definition, support and resistance. And the steeper that area is, or the difference in price and volume activity, how steep that node is and how well defined it is, the sharper or more intense that support and resistance are. And so you could very easily map out a market structure by finding those nodes and outlining them with maybe a box or lines, and then now you have found target areas, and at the bottom of those you've found support and resistance, depending on whether or not you're at the bottom or the top of those lines. Now here's another very interesting area that is specific to the volume well, the complete absence of the volume profile graph or chart or distribution. Those volume wells are very, very important as well. One particular aspect of it. Now, first of all, I had said that price tends to scoot through volume wells. They treat it like it's a hot potato, or I've used the analogy of the desert. If you've ever been in the desert, usually it's characterized by flat, hot plains for a long time, and then off in the distance there are mountains. You can think of volume wells or absence of volume and volume nodes like that. The volume wells being those flat plains that are super hot, that if you're going through there, you want to make sure that you scoot through those as fast as you can and get to the other side. You get to the mountains, the mountainous areas where it's cool, and you can hang out there, right? You don't want to hang out in the desert unless you have a death wish. However, let's say that you're in your car and you forgot to go to the gas station. You got to have a tank of gas, and you're thinking, I've got enough gas to get to the other side of the desert, to the mountains where there's another gas station. What happens if you get halfway through and you realize you miscalculated? I don't have enough gas. Damn, I don't want to get stuck in the desert. So either you're going to make it across, or you're going to decide at some point, I don't have enough, but I do have enough to get back. Well, that analogy is what I use for volume wells, because price is like that too. It'll come into the volume well, and it will either scoot across very quickly And that's why we see long bars, one right after the other, scoot across very quickly, or at the very lowest point, that point of decision. Can I make it across? It will make a decision. Can I get across here, or do I have to move back? Will I scoot across, or will I get rejected? And so for that point alone, that lowest point in the well is often support and resistance as well, because it's the line of demarcation. In fact, I mark up all my charts with those three primary things: the top and bottom of nodes, and in between I would consider those the targets, and then the low point of the wells, because I know that from a behavioral point of view, if price enters this market structure that I've created, it's going to move very quickly from one node to another, from the meat of one node to the meat of another node, and it's going to cross that desert and make a decision. Can I get all the way across? And if I can, I'm going to do it. If I can't, I don't have the temerity, the water supply, the momentum, then I'm going to move back. So now, knowing the market structure, what to expect in terms of price behavior as it enters this structure. So let's say that you have some momentum behind you, some sort of catalyst that's pushed you into the desert. That price, when it enters there, it's going to attempt to move through it very quickly. There's very little resistance. Doesn't want to be there. The market doesn't want to be there. Only every once in a while will it find a little oasis in the middle of a desert if it's a particularly large well and decide to hang out there for a little bit. But by and large, it will come up to that low point, maybe pause, and then move to the next node. Then you know that when it gets to that node, it's going to tend to consolidate, because that's what price does. It trends and it consolidates. It trends and it consolidates. It may then go back down and find the next node and then consolidate there a little bit and then bounce back up and then consolidate there. And if you look very carefully at the price action, the candlesticks or the price bars, and then look at the volume profile, you'll see this behavior performed over and over. You start drawing these lines that outline your volume nodes and the low point of your well. And again, you see these areas of support and resistance, points of inflection, lines of demarcation. And because of that, volume profile, because it gives you insight to the behavioral aspects and also support and resistance and likely targets for price, volume profile is by and far superior to any kind of technical analysis using trend lines or oscillators or other things that really don't take into account any of this stuff. Because within volume profile, you're getting all three pieces of information that are in the market, and the most important one being volume at a specific price. But you also get time. Those are the three pieces. Time, because it's a time series piece of data, price, and volume at that price. With candlesticks, you only get two things. You get time and price. Yes, of course, you can put volume below there, sliced up into those time slices, but it doesn't tell you anything about where the value is. It just shows you where maybe certain parts of the day there might be more activity, but it doesn't tell you where. And that's of little use to a trader to know that one part of the day versus another is more active, but it won't tell you anything about where you need to set your stops or your targets. Volume profile tells you all of that, tells you the whole story. The entire story is there, laid out in front of you. You can do a simple market structure analysis using the profile. If you have a directional bias or some catalyst that will tell you where price is moving, or just to see where price is moving at that time, you can very easily make up various scenarios on what might happen given these pseudo rules that I just gave you. The price tends to move quickly through the well. It consolidates on nodes. It uses the edges of nodes as support and resistance and makes that decision point in the middle of the low point of the well. And from that, you can develop very telling and accurate trades that model that kind of behavior. And that's how volume profile is used in trading. That's how the institutions use it. They are primarily using volume profile. Very few professional or institutional traders are using RSI and MACD and stochastic. Now, all of those have their place if you have computing power and you can create models based on statistical data that can use that. And there may be a place for that as a ancillary piece of information to help you with confirmation of the modeling that you do with the profile. But the profile is the truth. The profile is telling you what actually happened, and not only what actually happened at what price level, but what is likely to happen in the future, because those are positions that still are maintained and defended. Now, of course, the only place this really doesn't help you is if you're constantly hitting new highs, because there's no profile behind you to tell you what's happening. But it will tell you, if you're inside of a node at a new high, what level is likely to be breached and when it's likely to be breached and when it will enter that new level of a new well, a new place where the market is going to decide whether or not it will search out new value, price discovery. So that's volume profile. Let's see, we got some questions. Lance wants to know, does the deepest point of the volume well carry more significance versus the edges of the nodes? Well, only because price tends to move very quickly through there, and depending on the market, how strong the market is, it can provide, I would say, an equal amount of support and resistance. But it's not really real support or resistance. It's really whether or not the market has enough energy to move it to the next area of value. So it's hard to say whether it provides more or less, but if you looked at our most recent trades, my most recent market analysis, I draw these green lines where those wells are. And the past few days, the market has hit those levels and paused and hung out there before moving on, almost like magic. It was like I drew these weeks in advance or a week in advance, and the market hits them and recognizes them. I don't know why. It's not like the market is all looking at my volume profile chart. All I did was draw a line where the lowest point of volume was in that market structure. So it does have significance. I can say that you can use some guidelines on what's the relative strength of a volume node edge or a volume well low point, or the value low area, or the value area low. And that is the relative age versus how deep the well is or how big the node is. So in other words, newer nodes that are bigger have the ultimate in power. Older nodes that are smaller have the lowest value of power. And of course, there's a spectrum in between there. You could draw up a quadrant and then look at it from that perspective. That new big is stronger than old small. So hopefully that helps. Is the deep part of the volume well a magnet or a rejection point? It's neither. It's not a magnet. It's an inflection point. It's a point where the market has to make a decision. Does it want to continue up to the next node? Is it going to find value above there? And in some small cases, about 15% of the time, it may decide that, hey, maybe this is a good area to hang out and consolidate here. That happens occasionally, but it's really an edge case. So it's not really support or resistance, but it can act that way. It's really a decision point in the market, whether or not it should continue or get rejected. Morrow, do you use volume profile in your strategy to determine the direction, bullish or bearish, or the butterfly, or how far out to place it? Yes, 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 and no. So I don't use volume profile to determine direction, because the profile itself doesn't tell you what direction price is moving. Price will show you what direction it's moving. The trend will show you what direction it's moving. And given that, and given the amount of momentum that trend has as it enters that market structure, is what you use to determine whether or not it has what direction or what angle it's, and what's the possibility of what node it may go to next, or what well it might have to cross. So that's what we do every day. We're looking for some catalyst. If there's a lack of catalyst, when I say catalyst, I'm talking about things like economic reports, geopolitical condition, geo-macro issues that are going on, anything that will move the market in a particular direction. Once it's set into direction, it's like a physics problem. Once an object is set into motion, it will continue in motion until it finds an equal and opposite force to either push it off or at least slow it down. And that's what the wells, the low point of the well, and the volume nodes act. They are forces that are acting upon price as it traverses across the structure. JB says, it would be very interesting to hear you narrate your thought process as you place these targets and arrows and green lines. Well, I'll start doing that. That's a very good point. So what he's talking about is in the service, in the 0 DTE service. I provide this analysis every day, and then throughout the day of the market structure, and then the scenarios that I see happening. And so what he's asking is that I provide a narrative as to why I'm choosing where these lines are being drawn as I'm drawing them. And I don't usually do that. I usually do that very quickly and draw it up, take a screenshot, and then paste it into our Discord. I'll see how that works out. I'll try to narrate, and instead of just providing a static graph, I'll provide a video of me actually going through the process of marking up the market structure and why I put those things there. Because one thing that I'm sure if you ask anybody that's in this service, my analysis is almost always spot on. I provide scenarios, and where price goes, I would say I've got a 95% accuracy rating about determining where price will go. The one thing that is difficult in this arena is pegging the exact time. Will it happen in this session or next session or the following session? Who knows what holds for you in the future? But it's still good. It's good enough. A lot of times you can project what you think can happen in a particular day. So it's better than not having anything at all. That's probably the one thing that is a challenge, and that is with momentum, there's also the implication of some sort of span of time. And I guess all you have to go with is you look at what the previous momentum is and where it went previously, and you can extrapolate that to the new structure. That's about the best that you can do. And with trading 0 DTE, we have 3 opportunities every week, Monday, Wednesday, and Friday. So between one of those, I'm sure that we can nail how we model that market structure. So in terms of modeling from a options point of view, and what we're doing is we're using 0 DTE to collect premium on those days, or at least use premium collection as a principal component of enhancing or giving our trades an edge. We want to put premium collection strategies in places on the profile where we think price is likely to gravitate towards and hang out, because that premium collection really is a time-based thing. And so if we can determine where price is likely to go and hang out for a while, then that's where we're going to encapsulate that area or model our strategy. And primarily what we use are butterflies to do that. With butterflies, we can place them out of the money and create very magnificent risk to reward scenarios and model them and place them in areas where there's a very high likelihood with a very wide range of prices that we will profit. And so that's essentially how our zero DTE service works. It is a combination of doing this market structural analysis, then modeling it with these strategies, and then placing our trades that are asymmetrical and very small risk to very large potential reward. And we have a high incidence of being able to capture at least a good amount of profit relative to our reward. And every once in a while, we pin those trades and capture huge returns based on the risk that we take. So that's it. If you'd like to try out the Zero DTE service, you can go to zero-dte.com. Never forget that dash, because that will make all the difference in the world. If you don't put that dash, you'll go to another. Oh, hey, look, go to the other service. Go to zero-dte.com. Try them out. But if you don't put that dash, you're going to get a very different experience. And not in a good way, by the way, in my opinion. zero-dte.com/try. You'll get a 4-week trial. And in that 4 weeks, you're going to learn a great deal about volume profile, about developing option strategies that model the analysis of that market structure using volume profile, and then how to take advantage of that last day of expiration and that accelerated premium decay to create very highly profitable, very low risk, high potential reward trades. All right. I want to thank everybody up in the peanut gallery for your questions. And now it's time to get back to work. We have a trade that's about to break out. And that'll be a wonderful thing and make our zero DTE dreams come true. Take care and peace to you all. All right. Off button. Good. It's right there. Off.